One simple answer, Brian, would be that, like for the pivot points, Robert has given that website, MyPivots. I think it's mypivots.com or something like that. It has a pivot calculator, and you can do all your pivots based by just entering your high-low, open-close type of data, and that will generate it. And most of our platforms will self-generate a lot of these pivot points. So for that, those are kind of automatic calculations, or you can manually do it. And just real quickly, as far as Robert's levels and whatnot, those are long-term levels. So again, it does take a lot of time to explain those.
Yeah, and Brian, if there was something more specific that we're missing there, I say if you're just looking at show me how to calculate those from start to finish. I say I spent an enormous amount of time in a whole webinar in the indicators webinar doing that. So I can't really go through that whole process today because we'll run out of time for everybody else's questions. That's a big long one that was covered in the indicators. But if there's something specific, and it wasn't just how to calculate them or in general or the source of them, retype a question to Todd, because then I want to make sure we're not missing something obvious here for you.
Yeah, he's following up with, he just wondered how do you get those green band levels, and those are pretty much those confluence of various long-term averages.
Yeah, I tell you what, then let me just, as a real quick courtesy, go ahead and at a high level just demonstrate very quickly for all those you that came late to the indicator webinar and everything. Have patience with me for a minute. This will be quick. Just want to make sure I hit some high points. Brian, at a very high level, the source of the key support resistance levels is threefold. It's number one, like the weekly and monthly and sometimes daily pivots that are from the primary pivots, from the pivot points that we talk about each day that I was talking about here. So it's like I said, daily, weekly, monthly pivots. It's also then sourced from the Fibonacci numbers that we just talked about a little bit ago. Again, what happens is, like when I look for a move from a high peak to a low peak, and then I'll sit here and find the 50% level, 61% level, and the 33% level. I will see if that seems to happen to tie with other price action that I've seen in recent past, and I will go ahead then. If it is, I will mark that as part of the level as well. And then the other area that generates these is actual price support resistance levels, which are very important as well. And what I do with that is I will find areas that had actual price pivots. So what a price pivot is where it comes down, it reaches a point, and then rolls over. So I'm just highlighting some here for you right here. Okay. So this is one of the ways. And what's important about those levels, Brian, is that those are actual levels where price actually traded. Okay. So that's very important. You see back here, I generated one off of here, and then twice more than off of here, these two pivots. Well, look what happens. Here we come back several days later, we strike that zone, dead on, and then roll over, okay? Because price has memory. And people get trapped in certain areas in a price, and they're like begging, please, Lord, let's let it come back to me. If it does, I'll get out. I'll break even because my wife is going to leave me, my dog is going to leave me, the kids are going to leave me. Just let it come back, and I'll get out. So a lot of times you find areas that were important support become resistance, and vice versa. So there's three key areas: the pivots, the Fibonacci numbers, and actual price support resistance levels are where those support levels are all generated. And if you really want to do a deep dive and actually watch me kind of go through the process of doing all that analysis and all that, I'd recommend just looking at the indicator webinar, because I really kind of did a deep dive in one section on that. So that's it for that. Todd?
Okay, just in time, someone asked a question. And real quick, I know, Joe, I believe you had a question or two during the course of Robert speaking before, so if you could repost those questions, that'd be great. But right now we have a question.
Is this our friend
Hello?
Joe from the UK?
We have, I think, two Joes, actually. No, we do only have one Joe. Yeah, Joe O'Connor.
Yeah, great guy, but he's not allowed to ask questions today.
Oh, okay. Let me put him on mute. Hold
Yeah,
on.
put him on mute, will you? Yeah, great guy.
Okay.
Joe, I'm glad
Well,
you're here. He's been wonderful.
Mike, we do have a question for Michael in the interim. Is if the VIX breaks over one of the moving average channel lines, can the opposite channel line now serve as resistance or support?
Okay. If what we're referring to, I just want to make sure I'm speaking in what they're, when we're talking about the channel lines, we're referring to my channels that I have drawn here. Is that right? Could Mike confirm that for me?
Yes.
Okay, great. Sorry, sometimes it doesn't hurt to ask the obvious question, you know? So let me go ahead and expand this chart for you real quick. And let me just explain the way, the short answer is yes, they can act as resistance. In fact, you'll find, let me go ahead and blow this up actually for a second. Case in point was just here the other day, or yesterday. We broke through the channel to the downside because, you know, this is support, and support once broken becomes resistance. So we broke below it, rallied right back, and hit the channel dead on, the falling channel, and it rolled over. So Mike, the short answer to your question is absolutely. Okay, but I just want to add to that for you so you understand that the channel, I really like to go ahead and focus on using the channel as a trending identifier for me, because you see, like, you notice how we had the big rally on this at the open yesterday, and then we came right, as soon as we actually touched the channel, bam, it spiked up again. So, you know, I like to go ahead and look at this as kind of a moving average, if you will, trend indicator. But, you know, so hopefully you're doing that already, and then you're just wondering if you could use it then as it's a pullback indicator. If support once broken becomes resistance, then yes. But just make sure you're using it both ways for when we're in the direction of the trend, to demonstrate that, okay, you're on the right side of the trade, kind of like that ADX indicator, but then that you're also going ahead and, you know, acknowledging it as such. Todd?
Okay. Does anybody have another question pertaining to indicators, moving averages, Fibonacci's, any kind of support resistant level?
Todd, how many sections do we have as far as...
Just the three. This is the first one. The next one will be set up entries, exit stops, you know,
Okay.
Scaling and stuff, and then last one is just miscellaneous, which there's not a lot of stuff there.
Okay.
So it looks like we can actually move on, Robert, if you want to proceed with the setup questions and those other questions as well.
Sure.
Okay.
And I'm sure
So,
new questions will come along as you said
You
originally. You said originally there was 12 questions that were asked while I was speaking, so I'm assuming that some of those got answered.
they got
as I was
answered.
speaking.
Exactly. That's the beauty of your tangents. You usually nail them. All
Yeah,
right, so we're
I'm
gonna
sorry about my tangents, everybody. I certainly like to talk about these things and add color to them. You know, you say something for 20 seconds and you don't add all the other stuff to it, you don't really get the meaning behind it. And I've got a lot of years of experience, and there's a lot of things I want to share, and so I'm just trying to make sure you understand it, not that, you know, I'm just speaking for a couple seconds and giving you a simple yes, no. So for those of you that get driven nuts by people that just speak and speak, sorry about that, but hopefully it's helping most of you that I am speaking more than less. Go ahead.
Okay, well, let's go ahead and start with the setups and entry section. The first question will be, can you show us some of your, this is a very broad question, can you show us more of your more profitable setups? You know, and I guess, you know, we've already seen in other webinars the fish hook, the two-bar move. If there was anything else out there that we'd like to share, I guess that would probably fall here.
Okay. Well, one of the things that, you know, first of all, the fish hook, the bent finger, and the two-bar strategy are, you know, very good strategies. In fact, it's funny because I just got an email on that as well. The whole fish hook and bent finger thing has gone ahead since last weekend, and at least a couple people gave them more profitable trades and went ahead and, you know, made a difference for some people. So I'm pretty excited by that. And Todd, you seem to really catch on to a couple of those as well, as I recall. So, there's a lot of opportunity right there. What we don't want to do is have 20 different setups out there and be a jack of all trades and master of none. What I'd like to do is focus on people going ahead and understanding the opportunity for maybe some more pullback trades. Let me open up the chart here. One thing that I think people have more of an opportunity to take advantage of that they don't would be a pullback to the 20-period moving average trade. Because what happens is the two-bar setup, we talked about that a lot last week. There's a lot of variations of the two-bar setup. And so I tried to hit some of those last week. And if there's some people that want some clarification from last week that were in the webinar, boy, here's a great chance for you to go ahead and ask those questions. But a lot of my strategies revolve around variations of the two-bar break. So, keep that in mind that, for instance, the traditional two-bar break, let's go back into that for a minute, of course, is two bars decisively broken through, preferably on heavier volume, and then you get a pullback on lighter volume, and then you get a resumption of the upside. So that's the traditional two-bar break. However, the reality is that in a lot of cases, these first two bars move quite a bit, or the trend really gets going, it breaks down below, and then next thing you know, you can't look for a rally all the way back to like a 20-period moving average. You have to look for a rally back to like the speed lines that I've talked about. So I'd like to reiterate to people that, one of the things that for you, those of you that weren't last week's session or so, is the scale-in strategy really offers a lot to people like that, because what you can do is go ahead and let's say this was the two-bar break right here, and it's already moved from way up here all the way down to here. So now you're looking at this thinking, gee whiz, I've only got, like 2.5 points left of profit in this trade. So what happens is, you can say it moved a lot. One of the strategies I taught last week was starting right at the close of this bar, putting a contract into the market right here, and then looking to see if we rally up to the speed line, and then you could put another contract in. Then if we go ahead and rally up to the downtrending 20-period moving average, you put your third contract in, and then by then, either this thing is going to have already moved down right off this second bar, it's going to go ahead and fall, hit the speed line and fall, or as a last resort, it's going to go ahead and hit the falling 20-period moving average and fall. But either way, then you've scaled in. You've entered one contract here, so that if it goes ahead and moves right down the last 2.5 points, you've at least gone ahead and made a couple points on one contract or whatever. It depends how much you trade. Obviously, you guys saw in my last week, I showed you guys even on a light day, with I showed you my actual trading slips, my confirmation slips. Even on a light day, I was doing 85 contracts there at one point, you saw. So, so one contractor for you may be, 5 or 10 contracts for me, or whatever the case may be. So you have to look at how many contracts you generally trade in total, and then see if maybe you should start going ahead and entering. I really want people to focus on that, because variations of the two-bar setup are still a higher probability trade than what most people do is, they go ahead, what happens with the average trader is they didn't buy here, they didn't buy here, they didn't buy here, they didn't buy here, but by gosh, it gets all the way up here, it starts to break through, I'm not missing another rally again. They buy into this thing, it pulls back, moves back against them 5 points, they get stopped out, and they're losers and very upset. So, but here you had the two-bar break to the upside, okay? So if you added a contract at the close there, you see that we already had a quick move here, which you could have gotten in and out of for a scalp. Or you see, if you added one contract here, added another contract at the speed line, and then we're waiting to add another contract here. Well, you never got down to here, but you did get two contracts in as this thing rallied back up, and your basis was actually right here, so you walked away with approximately 5 points of profit on two contracts, okay? As an example of how you could trade. So, there you have just one opportunity. So what I'm saying is variations of the two-bar trade, which I was trying to emphasize for you last week, is more important than me teaching you another 16 or 17 different entries when you haven't mastered some of the others. Plus, as I mentioned last week, I'm very concerned about giving away a lot of other techniques or a lot of other setups out there when here we are 8 months later. I've been doing YouTube videos, and Todd, I think you've seen this firsthand yourself. I've been doing YouTube videos for 8 months, and people that have been around for a long time are still saying, now, is that a two-bar break, or is that the pullback? And these are people that have been around for a long time. So either they haven't really been listening as much, or they're having a tough time learning. Now I go add in a whole bunch more indicators or setups. I should say not indicators, because I've shared every one of my indicators in my indicator webinar. But setups, when we haven't even mastered some other ones that are already higher probability as is, why focus on lesser higher probability trades when we have these ones right before us that people still haven't used as much as they could? So, that's my answer to the question, Todd. I want people to focus on the variations of the two-bar setup that I taught last week, and also then the additional setups I taught last week with the fish hooks and bent figures, which I think you saw, Todd, yourself as well, worked very well last week for a lot of people.
Yeah, it's personally, talking to people in the rooms and just seeing, during trading hours, it's amazing how many, like just the fish hooks. I mean, on a given day, there's like, anywhere from 4 to, 10 fish hooks, so there's a lot of opportunity just for that trade alone. And then couple that with your two-bar moves. I mean, you got, probably 10 to 12 opportunities throughout the day. So those, I agree. I think, as we proceed, as the groups mature and hang along with us longer, I think it would be, then maybe more advanced, maybe less high probability trades down the road. But, why, I mean, if it's not broke, why fix it? I mean, these two trade setups are phenomenal as they are. Okay, next question will be, under what conditions do you not trade, even if an ideal setup is presented?
Wow, great question. I'm glad. I'd like to know who asked that question. I know you're probably reading off a list that was compiled, but I'd like to go back and find out whoever asked that question, because it's nice to know if somebody's actually thinking about when not to trade. And with that said, I'm going to go ahead and really harp on that, because I recall somebody in the channel the other day who was kind of frustrated that I was pointing out when not to trade. And knowing when not to trade is, as important as knowing when to trade, because how many of you have had fantastic days? You're making a ton of money, or you're having a great month or a great year, and in 1 or 2 or 3 fail swoops, you went ahead and either gave back the majority of your trading profits for the day, week, or month, or year, or in a couple of trades, you gave it all back. Could I go ahead and see a show of hands real quick? How many people, honestly, nobody else can see each other's response, how many people have done that? You were trading along great, and in one trade, you gave everything back that you went ahead and made. Okay, yeah, I'm seeing a lot of hands coming up there. So I'm going to go ahead and kind of focus on that for a minute, because knowing when not to trade is, as important. So I said, Todd, if you can ever help me find out who asked that question, that'd be great. The first thing I'm going to say is, if I'm having a really bad day, there's a whole lot of reasons not to trade. A family crisis, a family situation. In fact, you guys recall my mom had eye surgery recently, and when that happened, I wasn't in the frame of mind that morning. I was wondering, boy, is she going to go blind? There was a chance she was going to suffer retinal detachment and go blind and everything. She still actually got the second surgery coming up, so it's on my mind, but not like it was the morning of that surgery. So what did I do? to kind of get my head focused back in the game. Those of you that were in the channel live that day will recall, I actually did a webinar for you guys. I went in and did a little instant on webinar, popped it up there so you guys could kind of see what I was thinking real time, to kind of get my head back in the game myself. I was seeing things, but I just didn't feel comfortable going ahead and throwing a lot of contracts at this market. And for me, money management is as important, more important, frankly, as it is for anybody else, because when you are slapping around 50, 100, 150 plus contracts, you need to go ahead and have your wits about you. So if I'm sick, and now I've been feeling good this week, but my voice, as you can tell right now, unfortunately has been down. But if I'm truly physically sick, where I'm having a hard time staying awake and achy in that, I'll step away. If I have a major, family crisis, if I were married and I was fighting with my wife, or if I were fighting with my girlfriend, I would not want to go ahead and trade, especially if the fighting is about situations that you guys are having because of trading. If you're a man or a woman in this channel and you're trading, and you're having a fight with your husband or your wife because you took a loss, and your husband or wife is upset because they wanted to go buy something, or they thought they were going to have money for something, and now they're not going to have money because you made a losing trade, and you guys start fighting about it. What is a natural reaction? A natural reaction for many of you is to get right back in there and revenge trade and say, I'm going to show him or her, I'm going to make it all back up and more. And so what happens is, emotionally, you are in the absolute worst frame of mind you could possibly be in. You're going in and trying to make up profits. You're trying to force a trade, in most cases, that isn't even there, and you lose even more money doing that. So if you're fighting with your spouse about any reason, let alone trading of all reasons, step away from the computer. And some of you are sitting there probably saying right now, because I've had private conversations with a few of you, but Rob, I have to trade to make money. If I don't trade, I'm going to go ahead and lose money. I'm desperate. I have to trade. And I'm here to tell you, if that's the situation you're in, you probably shouldn't be trading, or you shouldn't go ahead and be using trading as your sole source of income. I would strongly encourage you, take a job at night, or for our colleagues over in Europe, it's great. They can have a day job and then come trade the American markets at night. So that's great for you guys. But if you're an American citizen and your American time zones, take a time job or something, or do some sort of part-time work to get some income rolling in, so that trading is not your only source of income. Because when you are feeling compelled to trade, and you say, I have to make this trade because I have to pay my bills, you are asking for a lot of trouble. I can't emphasize that enough. In the early 90s, I know what it's like. I was there. And so I did the same thing, and I would strongly encourage you to go ahead and think about that. Are you making trades? Are you forcing trades because you feel you have to? Because if you don't, you're not going to pay the bills. And then ask yourself, well, how has your trading been going when you felt that way? Were you consistently making money when you got upset and pulled the trigger? Or were you finding you were making just as many mistakes as you were winners? I suspect for the far majority of you, except for that 1% that anger actually makes you do smarter things, I suspect the other 99% of you probably found yourself in a more losing position because you forced things that weren't there. So with that said, if you're ill, if you're fighting with your family members, if you have a family situation, anything that's encompassing parts of your brain throughout the day and allowing you not and keeping you from focusing on trading is an absolute reason to stay out. Another reason, excuse me, let me clear my throat if I may, please. Okay, another reason is to go ahead and avoid the trade. There are a number of times when I've gone ahead and said in the daytime trading channel, both in the public channel and the private channel, I've talked about things being too much Vegas for me. Okay, so things such as the FOMC announcement, the 8:30, 10 o'clock opening bell, right, right at those marks there, a couple seconds before, a couple seconds after. I'm sorry, but from my perspective, I've been doing this for many, many years, and I have not figured out and I'm a fairly smart guy, I'd like to think, and I have not figured out a way to successfully, consistently trade the opening economic data, the opening bell, and the FOMC meetings. There's just too much Vegas. They'll whip up, they'll whip down, they stop people in, stop people out. I like to go and sit down, let all that rigmarole go through. I get a big kick out of reading chat boards and different things like, oh, this is the economic number, this is what it means to the economy, and this is what it means to our trading today. And then, you look as you go through the day then, and everybody expected the market to go up for the day, and it goes down. Well, then CNBC, of course, comes out with some excuse as to why it went down. The very next time you'll get the same reaction, and CNBC will come out with a reason why it went up for the day. You can't trust the news on these matters, and frankly, the economic reports will be interpreted different ways. You get 10 different people, you're going to get 12 different interpretations of the economic reports. And so, my point being with that, I do not trade right at those times because it's too much Vegas. And so you'll hear me use that term, too much Vegas, in the chat room. So those are other reasons. So those 4 reasons, economic reports, family situations, mega events, fights with the family, and or health reasons are reasons I will not trade. And I can't emphasize that financial one enough because I've had a couple people come to me. I'm certainly not going to mention names, but I've had a couple of people come to me and say, you know what, Rob, I was trading stocks. I've fallen below my day trading margin rule now in stocks, and so now I want to trade futures. Okay, I want you guys to think about that concept. And I know some of you in this room may be in that same boat, but I want you to think about it. I'm your friend here. You guys know that. I try to tell it like it is. I try to help you and keep you guys from losing money. A guru is not going to matter, or not going to care about it. They just want you to buy the next program, buy the next thing, buy the next service, buy the next $400 chat room. I'm trying to give you guys real food for thought here, and sometimes that may rub you the wrong way, and I apologize about that, but think about this. If you've gone ahead and been a stock trader and you had yourself a $50,000, $100,000 portfolio, and now you've dwindled it down to $25,000 on stock margin, on stock trading margin, okay? Now you've fallen below the $25,000 pattern day trader rule. So now suddenly you want to get your leverage back up and go trade futures. Okay, I want that's not necessarily the best move. I would strongly encourage you to talk to a registered financial representative and ask if you're really doing the right thing for yourself. I personally don't feel that it is. So I'm certainly not going to encourage people who tell me I've lost a bunch of money in stocks, so now I want to trade futures. You're not going to see me go and say, oh, yeah, you're going to make millions in futures now when you couldn't do it in stocks, okay? So I hope I didn't offend anybody with that, but I do want you to think about that. If there's anybody in this room today that's in that situation where you want to go trade futures now because because of the high leverage when you've lost a bunch of money in stocks, if you're just going to jump right into it, trade futures, I'm very concerned for you, and I would ask for you to get professional help on that before you do that. So don't go ahead and trade futures just because you don't have enough money because you lost it in stocks. Okay, so Todd, I guess I'll leave it with that. But I just really want people to take that as food for thought because I just don't want to see people hurt themselves.
No, that's great advice because that's definitely stuff you wouldn't get from a guru type like you're saying that's just interested in money and getting you to buy stuff. The next question here is under what conditions do you immediately buy or short without waiting for an ideal setup?
Well, I do that quite frequently, actually. Obviously the things I've shared in YouTube and my webinars to a lesser degree, I've tried to share more in the webinars, but it is very conservative in nature. But I tell you, certainly one of the things that I do very frequently is if we get that 2-bar setup in the market here, I will go ahead and where we get when I'm talking about two bar setup now, I'm actually referring to the first two bars. So I will take what I'll do is I will take a situation where we have a confirmed two bar setup, and I will actually dump stocks in. So if I were sitting in front of the computer right when this happened, and it were not during the opening bell during the economic reports or so, if this was just intraday trading activity, more likely than not, I will probably start scaling into a trade like this, where we get the first two bars locking in a directional movement. So what's different about me versus what I preach in like the YouTube channel and stuff? For conservative nature reasons, I like to go ahead and tell people wait for a pullback. Why do I tell people to wait for the pullback? Well, because if you go ahead and you short, or excuse me, if you buy right here, and let's say we're trading at 1210, okay? Well, this market could pull back 1208. I mean, by the time the rising support hits, this could be 1208, 1207, 1206 down in here. So the reason why that's why I don't go ahead and tell people, oh, buy the close of this bar here, because what happens is you may take some heat, and I hope that if a stock would move back 4 points on somebody, that they would actually get stopped out. I hope that most people's stops aren't. I see a lot of people that go to take 1 or 2 point profits, but then they go ahead and they let their stops be 4, 5, 10 points. That's a losing game, because you think about that. You take a 1 point profit, and then you go ahead and you take a 5 point loss. You now have 5 trades just to go ahead and sort of break even, and actually after commissions, you're still losing. So from a conservative perspective, I go ahead and I teach people to go ahead and wait for a pullback, because that way then if you put your first contract in here, unless you're dead wrong on the trade and it starts to break through the rising support, which will happen far less than not, then at least you've gone ahead and gotten at a much lower basis. It starts to rally back off, blasts off to the new high, and you're just making money the whole time. But what I like to do is go ahead and let me go ahead and, if I may, just clear this and redraw it. I like to go ahead when we get my solid 2-bar thrust. I will actually start entering. I'll take a contract, a contract position in here. And then if I see the rising support is until down here, I'll look at the number of points. And I kind of taught this last week. So let's say that this is 6 points away to the rising support. I'll go ahead and look at dumping X number of contracts in here. I'll look 2 points away. I want to dump 2 more contracts in. 2 points away, I want to dump another set of contracts in. And then, the final 2 points away, I'll go ahead and dump some more in. And then, as we get down to the actual support, then I'll buy any remaining contracts I want for that position. So really what I've done is I've started entering right here, and my basis for the whole trade ends up being right about here. As we get to the support level. Well, the reason why this works for me is because how many times after the 2-bar thrust do you get maybe just a little bitty pullback here, and then all of a sudden the 3rd bar breaks out to the upside, or continues the trend to the upside, if you will, or it barely pulls back, or it pulls back on heavier volume. There's this enormous amount of things that can go wrong with the perfect setup. As you see, there are some days where we don't even get the perfect setup. It seems like we usually get at least one good, solid, decisive breakout trade a day, but not always. And so, and even still, one trade enough isn't enough for most people, because what they'll do is, since they're a lot of them before they come to me are losing traders, they go ahead and they as soon as they make a point in that profitable trade, they get out. Well, so then they're like, well, I can't live on 1 point a day. So then they go and suddenly start trading in and out of positions constantly. So what I do, though, to get into more trades is, like I said, use this scale-in strategy. It's something I spoke about quite a bit in last weekend's webinar. It's a pivotal concept in my trading, okay? Now, that being said, I'd like to go ahead and point out there was actually a question about this that was sent to me personally. So Todd, I'd like to interject on that question real quick and answer it for the person, which was, okay, you use the scale-in strategy. How do you know you're wrong? Well, let's go ahead and clear the screen here real quick.